Hey, good afternoon, everyone. It's Terry Gardner from CJ Lawrence, a division of Apollon Wealth Management. That's right. As many of you know, in February of this year, CJ Lawrence was acquired by Apollon Wealth Management. We are now an investment management division of Apollon and are excited about the prospects going forward. The combination is really allowing us to focus on investing, on analysis, and on generating high quality ideas for our clients. So we're excited about the combination, look forward to leveraging Apollon's resources, particularly the Chief Investment Officer, Eric Sterner, and his team and the work they produce. So more on that to come. But what can you expect from us at CJL in the future? Well, the same type of work that you've become accustomed to in the past and got to know us and follow us for. My business partner, Bernard Cupp, and I will continue to deliver content that is deep in top-down analysis and leverages the models and tools for which CJ Lawrence is known and has built a reputation for. So look forward to providing more in the future. So let's get into some market commentary now. We seem to have come back from the abyss. For frame of reference, today is the 14th of May. It's about midday, and the market is back in positive territory, albeit slightly for the year. I'm going to cover a couple of topics. One being, where are we in the market? Second, I want to take a look at earnings and interest rates. Third, let's run a comparison to another period of time where tariff uncertainty was kind of front and center. And then fourth, we'll discuss some risks and rewards for 25 and 26. So, as I mentioned, we're back in positive territory. Who would have thought, based on all that we've been through? And in fact, we're up 12.5% from this time last year. So from May 14th of 2024 till now, we're up over 12%. And in fact, on a 2-year stack basis, looking back to May of 2023, we're up a whopping 43%. It doesn't feel that way, given all we've been through over the past month or two, but those are the facts and something to build on. So as the old saying is so true, it's not your timing in the market, it's your time in the market, right? So getting in and out of markets based on headlines is particularly challenging. As we've always advocated, staying in the market is your best course, as the market always finds its way through challenging times, right? So let's talk about earnings and interest rates, because they're the underpinnings of what's going on, albeit there's a lot of uncertainty around the future of earnings and interest rates, but there's some clues that we've been able to pick up through the first quarter. First off, the first quarter numbers from the S&P 500 companies were really quite good. As of today or last night, earnings are up 13.5% over last year. It was just a couple of months ago they were expected to only be up about 11%. So numbers are coming in above expectations. Maybe there's some pull forward there, but it seems to us that the companies in the 500 are executing pretty well. If you look out, now that earnings calls have taken place and earnings expectations from the companies have been recalibrated and analysts have recalibrated their models, we're getting a better look at what analysts are forecasting for 2025 full year, and earnings are expected to be up about 9%. 9% this year and 13.5% next year, 2026. That's actually that's not too bad if you believe the hundreds of analysts who contribute to that consensus forecast. We think it's pretty useful. On the interest rate side, the 10-year has been staying between this 3.5% and 4.5% yield for the past 2 years or so. It's bumping up against the high end of that range, which is something to watch. But it's nothing out of the ordinary, nor is it alarming. So I guess the takeaway from the earnings outlook, again, a bit still murky based on the tariff uncertainty, and the interest rate outlook is that that's a reasonable backdrop. 4.5% 10-year yield, and 10%, give it on average, earnings growth is pretty good. And again, we'd look at the Fed perhaps coming in the back half of this year if things do soften more meaningfully with the Fed put and with with the prospect of lowering interest rates at the short end. The market and the consensus forecasts are suggesting that there'll be 2 Fed rate cuts this year. I think a lot will depend on where employment goes and where inflation goes. So my third point, there aren't that many periods of time in our market's history where we can look at trade wars and tariff impact on earnings and on markets. I think the comparison to the Smoot-Hawley tariff days are a little bit overblown, but I think there are other periods that are useful in terms of thinking through where we could go. Let me read you a couple of headlines, and then I want to ask a question at the end. So you've at least got to listen to this video through these media headlines about tariff and tariff outlook. Stock market was calm and strong despite signs that the general economy is still doing well with low unemployment, healthy GDP, and relatively low inflation. That was from a media outlet. The Trump administration tariffs on aluminum, steel, and other goods have introduced a large amount of uncertainty into the global economy. That was from a print media source. Even if more permanent agreements are reached, significant damage has already been done. Another big headline. China announced lower than expected industrial production and retail sales. Another. Bloomberg reported that Trump has been considering trying to fire Jerome Powell. And one last one. U.S. tech giants have come under intense regulatory and legal scrutiny. What year? 2025? Sounds like it. It's 2018. So I think there's some parallels to what happened in 2018 with the current environment. And if I look at where the market was and what the backdrop was, there's some similarities. Not perfectly correlated. In 2018, interest rates were on the rise. That's not the case today. But earnings were actually being ratcheted down on the fear of a slowing economy in 2019 on the back of these tariffs. Sounds familiar? So what we're hearing a lot about today is how earnings expectations have to come down more as a result of the threat of tariffs and the impact of tariffs. In 2018, so remember, in 2018, investors were looking out at 2019 earnings. The Trump administration was putting on tariffs on a host of goods, particularly with regard to China. Earnings expectations in the middle of the year, we're close to the middle of the year, were $174 for the year, and they were ratcheted down over the next couple of months to $166, okay? So from 10% growth expectation to 4.5% growth expectation. Sound familiar? We're at about 9% now. It's come down from about 10.5%. And a lot of economists and strategists believe that we're going to be down into the 5-6% growth. So kind of similar growth expectation reductions. And in fact, the market did quite well, right? We had a big sell-off in 2018 from October through Christmas Eve is when the market bottomed and started to recover in 2018. And 2019 was a banner year with the S&P 500 up 25% and the NASDAQ up 35%. So fairly similar circumstances, a lot of the same rhetoric, a lot of the same headlines, a lot of the same earnings estimate revisions downward, not into recession, but the market recalibrated, companies navigated, and the market rebounded very strongly in 2019 in the next 12 months. So maybe there's a lesson learned there, something to keep an eye on. So, to our last point, number 4, we're not suggesting that, it's up and away, and we're not ignoring the risks inherent in this market. There's still a lot of things that could upend the progress that we've made to date. A couple of risks that we've been examining and worth highlighting would be, this durable goods pull forward. A lot of companies have been ordering goods, trying to get ahead of tariffs, and that may be inflating sales numbers and shipment numbers for the first half of this year, that could lead to a slowdown in orders, durable goods orders, and retail sales in the back half of the year. So that's clearly a risk. I think that's probably fairly well known in the market at this point. We're watching Treasury auctions as the 10-year yield bumps up against 4.5. We're going to have to see what kind of appetite there is for our Treasury auction, U.S. Treasury auctions in the coming months to see if yields will break through to the north, up through that 4.5% on the 10-year. So that's something that would obviously have an impact on stock price valuations and cost of capital for borrowers. And then finally, the threat of additional tariff showdowns. There could be, more negotiations that fail, more renegotiations. So, uncertainty seems to be the watchword that everyone's using, and that would clearly create a little bit of doubt over the markets in the coming months. Potential underpinnings. Earnings are hanging in there, and estimates are hanging in there. So we could see a situation where even if the economy softens a bit, companies figure out how to navigate the environment, and earnings growth remains at least robust. It doesn't have to soar, but it doesn't, as long as it doesn't crater, the market can hang in there. I used to be a freight transportation analyst back in the 90s. We always had a saying that freight will flow like water going downhill. It will always find its easiest path. And that's what shippers will do. That's what importers will do. That's what companies that have global supply chains will do. They'll ultimately adjust and find the easiest path. So there may be some disruption in the meantime, but ultimately they find their way. And one thing from a stock perspective that's really creeping into the market now is stock buybacks are at a relatively historical high level. And companies are flush with cash. So if stock prices are weak or there's opportunities, companies can step in to be the buyer there. Lower gasoline prices could potentially offset any impact from higher prices in some goods. So there is some offsetting in the economy when it comes to inflation. Perhaps increased onshore activity precipitated by some of this tariff overhang, perhaps offset some offshore slowdown. And then there's always the potential for the Fed put. If the economy slows meaningfully in the back half of the year, expectations are for 2 cuts to the Fed funds rate. Could happen, could be more, but that's always a prospect for the market if things aren't working well. So finally, what we would kind of wrap up with is the thought that in the end we still want to be invested in the market, right? Despite the ups and downs and the volatility, and we want to focus on the areas of the economy that are benefiting from secular tailwinds rather than relying on an incoming economic tide. So with that, we'll wrap up our first video for the new year. Look forward to following up with all of you in the coming weeks and months. If you've got any questions, feel free to give me a ring at 212-888-6403 or my new email, terry.gardner@apollonwealth.com. Thanks and have a great day.